You think you know the S&P 500, right? It's the benchmark. Everyone talks about it. Represents what, 80% of the U.S. market?
Absolutely. It's massive. That aggregate market cap was past $49.8 trillion back in March 2025. It's the standard.
It really is. The ultimate pulse check, for how corporate America is doing, or so we think.
Well, yeah, that's the common perception.
But what if that pulse isn't just happening? What if it's being, curated, managed by a secret committee?
Exactly. That's the paradox. We see these indices as objective, data-driven things, algorithms, right? But the S&P 500, there's a definite human subjective element right at its core. It really makes you question things.
And that's what we're doing today, a deep dive into this active management, especially around the September 2025 rebalancing. Because these decisions, they raise some big questions. Transparency, fairness, you name it.
Yeah, it's critical stuff, because when an index guiding trillions of dollars involves active human choices, well, it's not just a mirror anymore, it's actually shaping the market.
Okay, so let's get specific. This recent rebalancing, September 2025, announced September 5th, effective September 22nd. Who got in?
Right, so the new entrants, we saw Robinhood Markets, Herd, AppLovin, APP, and MCore Group too.
Robinhood makes sense on the surface. Big fintech player, connects retail investors, crypto.
And their numbers were strong. Q-tier 2025, almost $1 billion in revenue, good profit. And that crypto trading revenue nearly doubled year over year. Big jump. Shows they're adapting.
Definitely adapting. And the market noticed instantly, didn't it? That stock surge, 7.5% after hours.
Textbook index effect. Huge vote of confidence.
Yeah. And AppLovin, the mobile tech ad stuff, MCore, construction facilities.
Yeah.
They seem like okay picks too. Sector diversity, maybe growth potential. Seems logical so far.
It seems logical, but it's often what doesn't happen, the exclusions, that reveals more about how this committee operates.
Oh, okay. So this is where the subjective part really comes out.
I think so. This is where you see the discretion in action.
Right. Let's talk about the one that made everyone scratch their heads. Strategy. Formerly MicroStrategy, MSTR. Left out. Completely.
Yeah, quite the omission.
Especially when you look at the numbers. Market cap, $92 billion. The S&P minimum is what, $22.7 billion?
Way above it. Not even close.
And Q2 financials, $14 billion operating income, $10 billion net income, $32.60 diluted EPS. I mean, these are huge numbers. Large cap success written all over it.
And remember that accounting change back in January 2025, the shift to fair value for their Bitcoin.
Right, that was significant.
It was huge. Before that, accounting rules could force impairment losses, hiding the real value. But fair value let them show the market value of, what was it, 628,000 something Bitcoin?
Yeah, valued at $112 billion at the time. So the change painted a much, much stronger picture. Reflected reality.
Absolutely. Cleared up the accounting noise, showed the massive asset base.
So strategy hits all the quantitative marks, smashes them, really. Yet the committee says no, and the stock drops 2% after hours while Robinhood jumps. What gives?
Well, this is pure subjective territory, isn't it? It's the committee using its discretion. Analysts point to a couple of things.
Like what?
Primarily that heavy Bitcoin concentration, about 80% of their assets, and the volatility that comes with it. We're talking average 30-day price swings of 96%.
96%, wow.
Well,
Okay, that's not exactly stable blue chip territory.
not at all.
No.
And the committee might see that as just too risky for their main index. They might also view Strategy's model as too much like a closed-end fund.
Meaning it just holds assets rather than being an operating business.
Pretty much. The S&P 500 generally prefers companies generating revenue from services or operations, not just holding volatile assets. They tend to exclude closed-end funds.
Okay, so they value the type of business Robinhood's diversified services over Strategy's sheer size and profit numbers because of the perceived Bitcoin risk.
That seems to be the read. It's a qualitative judgment call. As Jeff Park over at ProCap BTC put it, it reflects that institutional caution around pure crypto plays. They prioritized perceived index stability over Strategy's individual, albeit massive, performance.
So it's not passive at all. It's active decision-making. So who are these decision makers and what are their rules exactly?
It's this S&P U.S. Index Committee, 10 members, all anonymous, decisions by majority vote.
Anonymous, really?
Yep. And they do use quantitative rules. Minimum market cap, like we said, $22.7 billion. Liquidity ratio, trading volume minimums, positive earnings over the last quarter and year.
Okay, the hard data points.
Right. And this is the crucial part, they also use qualitative factors, sector balance, company stability, industry representation. And these qualitative factors, as we just saw with strategy, can override the hard numbers.
Which firmly puts it in the actively managed camp, even if everyone calls it passive.
Absolutely, it's managed.
And it changes regularly. Quarterly rebalancing.
Yep. Announced first Friday of March, June, September, December. Takes effect third Friday. Plus, they can make ad hoc changes anytime, due to mergers, bankruptcies, stuff like that.
So lots of opportunities for these discretionary calls.
Exactly. And each call matters because of that index effect.
Right. The trillions tracking this thing. How much is it now? Nearly $10 trillion in passive funds globally.
Something like that. So when a company gets added, all those funds have to buy it, drives the price up, get excluded or removed, they have to sell. Price drops.
Huge power for an anonymous committee, real financial consequences.
Massive consequences. It really underlines why their methods and transparency matter so much.
Okay, but let's talk about consistency, or maybe lack thereof. Here's something wild. About 28% of the companies in the S&P 500 don't actually meet that $22.7 billion market cap minimum. That's like 140 companies.
Right.
What's that about? How can it claim to be the largest firms?
It's a fair question. The nuance there is that the big market cap threshold, it's mainly for new companies getting added. Once a company is in, it can often stay in, even if its market cap dips below that $22.7 billion, unless there's, a major reason to remove it.
So it's about continuity, sticking with companies already in the club.
Sort of. Prioritizing continuity and maybe sector balance over strictly sticking to the size rule at all times.
But that means it isn't really the 500 largest countries at any given moment.
Yeah.
It's the 500 the committee decided were largest at some point, plus some inertia. It definitely feels actively managed, not purely objective.
It does deviate from a pure size-based approach. Smaller companies can end up staying in while potentially larger ones wait to get added. It's another layer of subjectivity.
Which brings us back to the committee itself, anonymous, making these huge calls. That lack of transparency is, well, it's concerning.
It is.
Yeah.
Especially when they make a call like excluding strategy, which met the numbers, and there's no detailed public reason given, just silence or vague references. That opacity naturally leads to speculation.
You have to wonder. No direct proof of insider trading, obviously. But when you have anonymity, huge financial stakes, Robinhood jumps 7.5%, strategy drops 2%, people are going to ask questions. It's just human nature.
And it hits a trust, doesn't it? Trust in the markets. Transparency is just fundamental. Maybe disclose who's on the committee, or at least publish detailed reasons for the decisions, especially the controversial ones.
Seems reasonable.
It could really help investor confidence. Otherwise, that perception of a potentially rigged game, or at least an opaque one, lingers.
So if the S&P 500 has these issues, subjectivity, inconsistencies, lack of transparency, is there a better way? An alternative benchmark?
There is. The Bloomberg 500 index is gaining attention precisely because it avoids these issues.
How does it work?
Purely objective. It simply tracks the 500 largest U.S. companies based only on market capitalization. That's it. No committee, no qualitative overrides, no subjective calls.
So a company like Strategy with its $92 billion market cap, it would just be in. No debate.
Exactly. If the market cap puts you in the top 500, you're in. It's a much purer reflection of market size without any committee filter.
And people can invest based on this.
Yep. There are ETFs, like the Strive 500 ETF, that track the Bloomberg 500. So investors can get exposure to the actual 500 largest firms by market cap without the S&P's committee layer.
Okay, look, the S&P 500 isn't disappearing tomorrow. It's got history, inertia, massive amounts of money tied to it, like that SPY ETF with over $600 billion.
No question, its legacy is huge. But given the active management, the subjective calls, the fact that nearly a third of its companies don't meet its own size rule, you have to ask if it's still the best, most objective benchmark.
Compared to something like the Bloomberg 500.
Which offers that straightforward, transparent, market cap-only approach. It's arguably a more accurate snapshot of the largest players in the U.S. market today.
So maybe the conversation needs to shift. Should the financial world start paying more attention to alternatives like Bloomberg 500, just to give investors a clearer view?
I think it's a conversation worth having. It's about giving investors the clearest, most objective information possible. The benchmark you choose really matters. It defines performance, yes, but it also involves trust in the process.
So let's leave you with this thought. What does this all mean for your understanding of market benchmarks? If the S&P 500, the one everyone talks about, is actually actively managed, uses subjective criteria, and includes many companies that don't meet its own size rules, what does that tell you about the indices you follow? about the passive funds tracking them? What criteria really matter to you when you think about the biggest or best U.S. companies? Something to consider next time you see that S&P 500 ticker?